Hello, Peter Walker.
Peter, Daniel Montgomery, manager at Shore Funding. How was your weekend?
Good.
I know you said to call today. Listen, business is booming. I'm getting up businesses financing. We spoke about making a line of credit or a long-term term loan for the business, and I wanted to be able to get you some offers this week.
Well, that's very kind of you. I'm all taken care of. Thank you.
You remember speaking with me last week?
Yep.
You were a lot more interested. You got a loan over the weekend?
No, my situation changed.
So you're not looking to expand the business this year?
No, I already have the money I need now.
Okay, not a big deal. I'll close the file out. I wish you the best of luck. Thanks, Peter.
Okay, thank you. Hi there, this is Peter Walker. I am with Money Manager Review and also World Capital Management. Today, what I want to do is I want to talk about investing using a capital growth market system that I've worked on for a number of years. And what I'll do is I'll start off talking about my background. So I've been an analyst now for about 35 years. I've worked with a company which I created called Money Manager Review, and here's a little bit of information about it. I'm going to put that up here. So Money Manager Review is a database that I put together. The database is available by subscription, and subscribers get access to information that I collect on the performance of money managers around the country. These are all registered investment advisors, institutional advisors, and they're what are known as active managers. In other words, they are basically stock pickers, as opposed to indexers, which are considered or called passive investment management. So anyway, this database I've had now, I've tracked about 2,500 managers and over 10,000 portfolios on it. And I have the track records. I'm not going to go into it right now because I want to get on to what I am really going to be talking about today. But anyway, the point is that I've collected information over the years to see how managers compare and whether their strategies make any sense or not. So what I'm going to do is just explain what's happened in about the last 20 years. I'm not going to go into the detail here, but this will give you an idea as to where the market has sort of gone in this area. So as I mentioned before, there are two types of management styles. One is what we call an active manager, and an active manager is again a stock picker in that they choose what they consider to be undervalued stocks, and they put portfolios together based on whatever the criteria is for what undervalued means to them. But this is probably one of the most used methods for up until about 20 years ago to manage money. So almost all money was managed by people that would put together portfolios. And what's happened in the last 20 years is that you'll notice in this graph the money's moved from what they call the active manager side, which is this graph here going down, to the passive, which is really indexes. So all this money here that's gone from the passive has gone to the index side of the business. And that trend continues, and you can see it's probably even accelerated. So for every dollar that's gone from the active side, it's now gone to the indexing side. So the question is, why is that? Well, let's first look at what most Wall Street does when it comes to analyzing value on the markets here, and that is that This is just an example. If you look at Apple here, you'll notice that these are the recommendations here by the street, and you'll see that they have various kinds of ratings. And so obviously Apple here is a buy rating and is rated very highly by 27 of the analysts, and then this is showing you other analysts that are sort of more on the hold to buy side, but aren't quite as bullish on it. But still, it's obviously a very well thought of stock. And so in terms of the expectation, it's at 181.5 is the expected performance over the next year. That's what they call the target. Right now the stock is at 161.46 at the time that I put this in here. So obviously if you're a person who's interested in buying stocks, you'd look at this and the analysts and decide based on the targeted price as to whether this might be a good buy or not. Now you'll notice one thing about this, and that is that they're basing this on price valuations. In other words, the overvalued or undervalued price ranges that they give is based on really dollar amounts and percentages from those dollar amounts. And what I'm going to talk about here is another way to look at this, because I think the way analysis is being done on Wall Street is not a very good way to do it. There's a much better way to look at the markets in terms of valuations. So just to give you again further information about this, you'll notice this is the difference between the active and the managers, the ones that are picking stocks versus the indexes, and this is over a multi-year period. But you'll see the gray on top is the indexes, and the ones on the bottom are the managed stock pickers. And obviously there's a big difference in the performance, which again gives us further evidence that picking stocks versus doing a passive indexing approach generally tends to underperform. This next one here is a study that S&P's done, and it's breaking the market down more into different style categories. And you'll notice here that the red is showing you the underperformance, and the blue is showing you the managers that are outperforming. And generally speaking, over time, again, it looks like the performance of the indexers are outperforming the active managers. Now, in my analysis of managers, I came to a conclusion here, which was that yes, indexes tend to work better, and the basis of an index is that it's called market capitalization. There's a sort of a formula to it. It's very simple. It's just taking the share price and multiplying it by the outstanding number of shares. And as I pointed out earlier, that the way most of the time it's determined on the market, that is by the analysts, is that they're not looking at the market capitalization. They're really looking at just the price changes, and that's really not the best way to do that as far as the analysis is concerned. So to get a better idea, if you look at the total performance difference, this gives you a sort of an idea as to where this is going as far as my talking about the market capitalization versus active management. You'll notice that if you look at two of the very popular indexes, you've got the Nasdaq and you've got the S&P here, and the Nasdaq obviously is doing better than the S&P, and the question is, what's the difference? Well, the difference really comes down to capital market growth rates. Okay, so what's showing you here is that the stocks in the Nasdaq 100 are actually performing much better than the S&P, and the reason is being because of the way the structure is. And this I'll talk about in another video, but the markets are basically, when it comes to indexes and reporting on general index performance, based on this idea that it's capital based. In other words, it's the size of the companies And if you put it all together, you come up with your index. In other words, you take each stock, you take the number of shares outstanding, times it by the price, you come up with a capital size, and then you add them all up, and that gives you your index. So your index of the S&P is based on 500 stocks, and that's again based on adding up all their capital values. And then when you look at the Nasdaq, it's the same thing, except it's 100 stocks. These are stocks that are growing obviously at a much faster capital growth rate. And so my point is that what you really need to look at is not the changes in price. What you need to look at is the capital growth rates of these stocks as a group. And I'll give you further proof of my premise here, because I'm going to show you how this works out to actually a different way to evaluate the markets in terms of what value is in the marketplace. So if you look at, let's say, the top 50 stocks by capital size, okay, so I'm taking the top 50 companies traded on the stock market, and I'm breaking them or sorting them by capital size. Ones on the right there are the ones with the biggest capital size, and then you'll notice that about 5 or 6 of them are the biggest, and then they all tail off as you go to the left. But this just shows you the concentration of capitalization to the right, and then the the trailing off of the market in terms of capital sizes. And again, we're looking at the top 50. Now, when they put together an index, there's a very straightforward way, and they've done this ever since they started trading indexes. They simply take the money that's being invested and they break it into capital size. And so for the bigger companies, obviously you get proportionally more money put into those stocks, and then as you go down the list of stocks here, you go to the lower proportionality of your portfolio. And this gives you good distribution, and it gives you pretty passive type of investment strategy, because you're not worrying about any kind of fundamentals. You're not looking at the underlying earnings or any surprises in the earnings rates or other factors that might enter into your analysis. And so literally today, trillions and trillions of dollars are being managed using this approach, which is again a very passive one. It doesn't look at fundamentals, it just considers capital size. Now, what I'm going to show you next is really important, because when you look at the breakdown of these companies by not only size but by capital growth rates, you start getting sort of a better picture as to what companies are growing based on capital size. And so you'll see the red here is showing you the capital proportionally. This is just giving you an idea as to which ones are growing faster than the others in terms of their capital growth. So you'll notice as you go down our list, and this is the same list of the top 50, this is Apple to the right here. It's growing very quickly, but in terms of the capital growth rates. But as you start going down here, you'll notice that you have some that are, obviously a lot of variation, but then you get down about 10 or so companies. I'm not going to talk about specific companies, but you'll start noticing that we have some negative growth rates. Okay, so the positive here is what's above average on the line here in terms of capital growth rates relative to the average of the market. And the bottom is the ones here that are underperforming, and there's several here even in the top 10 or so that are underperforming in terms of capital growth rates. So as I pointed out before, when we looked at this example back here, that the difference between the two was due to capital growth rates. In other words, the difference between these two different indexes, that's the Nasdaq and the S&P, is because of capital growth differences in the underlying stocks that you put together to come up with your index total performance or index number. Whereas when you look at here, what you're looking at is, again, a list of stocks, but now what I've done is I've broken them down into their capital growth rates, and some are, as I say, growing faster than others. And so as we saw with the Nasdaq and the S&P, the logical conclusion is that you need to put together indexes based on their capital growth rates. That's the best way to actually put together a portfolio which has any chance of beating market averages. In other words, you want to put your money into stocks that are growing faster than the market averages. And so as we go down here, we're going to look at this next one, which is actually taking out all the slower growing stocks that we looked in our previous breakdown of the top 50. And now we're looking at the top 20 or so, 21 stocks with the highest capital growth rates. And we're proportionally investing using a capital weighted system just like we use in most indexes, but now instead this is really based on their capital growth rates. And so we're proportionally putting them just in the ones that are growing above average in terms of the capital growth rate sizes. And so that is sort of the premise that I'm getting to, is that in order to put together better performing indexes, what you need to do is to figure out which stocks are growing faster than the average capital growth of the market, and then just isolate those into a new index, just having those as your new index that you're putting your money into. So when you do that, you have, for instance, this kind of a chart. This is, again, the top 20 companies that we just were looking at. This is a pie chart showing you the breakdown of the proportionality of the money that you're putting into it. And this is the indexes that are the industry distribution of these companies. So this just gives you an idea, again, visually, of what this looks like. Now, what's important here is what's happened over the last previous months. So if you're going to do a system like this, which is, I'll show you because I have software that actually does all this analysis. If you take the top 21 stocks and you look at what their performance has been over the last year, those 12 months, in terms of their capital growth rates, based on a capital weighted index, you have a growth rate of 17, almost 18%, which is this blue line here. Whereas if you were to just put all your money on an equal proportional basis of the top 50 stocks, it's over the last 12 months was down about 7%. So there's a difference of about 25% between these two groups. And this is the basis of how you put this together in terms of a new index, as you're looking at this difference between sort of the total group of stocks that you're trying to figure out which stocks have fast capital growth rates and which don't, and which you should include into your new index. And so this difference is what you're measuring. So you're not predicting the market. What you're really doing is you're putting your money into areas of the market where the growth rates of the underlying capital is fastest. So just to show you the underlying software, this is the software that does all this. And I can show it to you live in a second, but essentially what you have is you have the list of stocks that you're looking at, and then you have scroll bars that are used to then adjust these stocks. In this case, these are the top 50 stocks in terms of market size, capitalization. And this is the breakdown of the cap sizes. This is the difference between the indexes and the averages in terms of their growth rates and also their betas. So all this can be adjusted various ways. I'm not going to go into this right now, but anyway, this is a very sophisticated program. It's very easy to use actually, because it all runs using a a very simple dashboard to it, but it's powerful in that it's looking at the underlying market in real time. These are all stocks that are updated in real time. And then what we're doing is we're just narrowing out the index. It actually builds a new index very quickly that uses these faster sectors of the market. So I will just go and show you the actual underlying stocks here. So just give me a second here and I'll do that. Okay, so this is the actual underlying index here that does this. This is in real time. And let me just get in here and I will go to the company, the index here. Excuse me, I didn't actually, this is it right here, I'm sorry. This is the one that we're going to be looking at. So, so here we are. Let me just straighten this out a little bit. I'm going to put this into a better looking window here. Excuse me while I get this put together here properly. Just give me 1 second here. Having a little bit of a technical issue trying to find out where this is on my. But anyway, I'll just use this. Anyway, so here we are. We've got the stocks on the right here. And we have a scroll bar here. Now, when I put the scroll bar to the left, I'm starting out with the top 50 stocks. And what we're interested here is this difference between these two groups. That is the total 50 stocks and the index, which we're going to be looking at here, that we're going to optimize. And so as I move this to the right, that is the scroll bar, what's going to happen here is we're going to be taking out the companies with the slower capital growth rates. This is all being done in real time, and the analysis is being done very quickly. But again, what we're doing is we're removing all the companies that have very slow capital growth rates. And you'll notice here that the difference on the right here between these two lines has changed. I'll just go back here for a second. I'll show you where it started from. So we started here where they're almost together, and then as I move it down and take out about 30 of the slower growth stocks, you'll notice that this change is gotten very pronounced here. So the differences I showed you before, it's about 25% in the capital growth rates between these two groups. And so what we have here in this list is the actual portfolio, and we have the proportional amounts here, which is what you actually trade with. So what you're doing is here's the list of the stocks that's now in this group that's optimized. Here's the weights of the portfolio, because that's how you put together these index composites. And then here, just to visualize a little bit better, we have the way it's broken down by stock, and then we have the indexes in here. So in a nutshell, this is how it works. It again is based on not looking at the changes of stocks, which is not really the best way to measure stock performance. What we're doing here is we're looking at the change in the capital growth rates of individual companies and then putting them together in a new index with the fastest growing companies. And if you're a person who's buying an index right now, as I showed before, all you're doing is you're buying them based on cap size. And again, the difference here is we're looking at which companies have the faster capital growth rates and then using those companies to build a new index. And I'm not going to show you all the features of this, but if I wanted to, I can adjust things like the beta of the underlying companies. I can like turn down the beta and make the portfolio less volatile if I want to. I have all those measures on the screen. I'm not going to go into it right now, but I can actually adjust the beta rates of the portfolio based on their historical performances. I can also change I'll do that right now, the capitalization maximums of the portfolio. So if I want to get a little bit more diversification, I can change that. I can set it from, let's say, 100%, where right now, for instance, Apple, which is the biggest one in our portfolio, is at about 20, I think 25%. Whereas if I wanted to, I could make Apple a maximum of 15% and redistribute the portfolio, which I just did. Now you'll notice the portfolio is more evenly distributed, and then that also affects the capitalization differences. Here we had about 25% difference here. Now we have almost the same. So this hasn't really affected the actual historical growth rate in the capitalization, but what it's done is it's diversified the portfolio by cap size a little bit. So these kinds of features are built into this, which allows you to adjust your portfolio very quickly. So we're doing really something that you could never do if you used even a spreadsheet to figure out, because this is all hooked up to the market. All these changes I'm showing you is all controlled by algorithms, and they're all interconnected, so they're integrated together. So as any of the prices change, or if I start changing these scroll bars for either volatility or cap growth rates, this is all being done in real time, so the portfolio you're looking at gets optimized in real time. So this is how it's done. I'm going to finish this right now. I hope you appreciate the methodology that's being used, because I think it's much better than what's currently being done now. And I just want to point out that if you look at the markets, there are literally trillions of dollars being invested using capital weighted indexes. And again, their shortcoming is they do not look at the capital growth rates of individual stocks, and they don't take out those stocks which are not really growing as fast as the market. And this is a very powerful program in that it does all that automatically in terms of the analysis. So with that, I'm going to thank you very much for your time. If you want to contact me, I'll just give you my contact information here. And just give me a second here, and I'll get back to the program. And this is going to be my contact information right here. So again, thank you very much. This is Peter Walker. I'm going to say goodbye, and thank you for your time. Have a great day.